Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, the ongoing market turmoil is a stark reminder that investing is not just about riding the highs, it's also about surviving the lows. And today, with Dhirendra Kumar, we'll discuss some investing principles that can help you navigate this downturn. Welcome, Dhirendra.
Thank you.
First up, when markets fall, most investors, they tend to panic. So what do you think is a smart strategy or smart way to reduce the impact of downturns on our portfolios?
There is no smart way. Any smart move will not help you reconcile or feel happy about a market fall. It is painful. When you see yesterday you saw on a weekend, on a Friday you saw that your investment was something like 3 lakh rupees and you are a new investor. Started investing 6-8 months back, a year ago or 2 years ago. And today when you see that, okay, it is down 4%, you don't feel happy about it. And there is no easy way to feel happy about it. The only way you will be happy once you get used to it, once you start looking at the benefit of it. If you are going to, assuming that your total net worth, financial investments, you invested 2-3 lakh rupees and now it has become 5 lakh rupees because the recent past was very good. And now that 5 lakh rupee has become 4.5 lakh rupees or 4 lakh rupees, it has gone down by 25%. And you still are investing. You don't need this money. And if you are still going to invest and you are going to invest for many, many years, every reason why you should feel very happy about it. That to make money from the market, you need to buy cheap and you need to buy when it actually goes up dramatically. And in a couple of years' time, it will go up again. But in the short run, it is impossible. So if you have these 2-3 variables in place, you might feel happy, or you may not panic. But to feel happy about it, you need to experience it.
Right. So like you mentioned, a lot of people, they get caught up in the race chasing hottest stocks or hottest sectors. Why is this risky and how can we avoid falling into this trap?
Investors come to market with huge expectations, and more so new investors, they get carried or they get attracted that, okay, this is doing very well, let me buy it. Investing is a very optimistic act. You don't make investment to lose less. You make investment to maximize your return. And here is something which is able to demonstrate that if you would have, in fact, it causes regret to people. I wish I had invested. Your starting point is that you try to invest, and that normally is a vehicle which is not diversified. It is little concentrated. It is not something which has been tested and proven over a full market cycle. It is only a demonstration of what did very well recently. When you make such an investment, that is also the segment of the market which has done exceedingly well and is very inopportune and very expensive. And if it is a combination of these three things and you invest and the market turns around, if it does not turn around immediately, it will turn around after a couple of months, it will turn around after a couple of quarters. And normally that has been the case. And the people who get trapped into this, the people who get attracted into this, the people who are predisposed to getting attracted to such a thing, are the people who don't have experience. They are naive and gullible. They are being told these stories and they are able to easily buy those stories. And that is where the whole problem starts. Most of the time, investors make those investments and they are not SIP. You are not averaging over time. Normally you are trying to ride the bus as soon as possible. So all these variables are very much against you. That makes you a very poor investor. And but despite that, I feel that assuming that you take this wrong step, assuming this is a mistake, and it turns out to be a mistake after you have done it, I have felt that if you do this with an IPO, it will be problematic because you are not diversified and you have caught a peak. If you bought some stock, maybe Paytm or Nykaa, you will be down 40-50%. And it will be extremely disappointing. Here, the advantage is that you are still owning a diversified portfolio. You have caught the market high. And if you start your SIP, you can still moderate your losses. But still, most of the time, this is the complexion of the people who actually get caught into this, and they are disappointed and they are hurt.
All right. So, like you said, people often, chase a recent story or a recent stock that has done well. So, how important is it to find the right mix of investments to make their portfolios more resilient?
It's very difficult to find the right mix, because right mix for you will be very different, right mix for me will be very different, right mix for a 70-year-old person could be very different. So the right mix is actually a function of what is your experience, what is your investment time frame, and how critical that money is. It all depends. It actually depends on these three factors: time frame, scale, and how critical that money is, besides experience. So I think, the simplest rule which anybody should follow is that you need diversification at any cost. If your only investment is going to be a thematic fund, which is not narrow, it is not like a sector, still it is undesirable. Make sure that you are something which has exposure to all segments of the market as much as possible. Don't worry about the mix, because you have to worry about the mix and protect yourself from downside after you have built something. So think of asset allocation only after you have been able to build something to the tune of, I would say that 5-year worth of your income accumulated, that is the time when you should worry about. Because assuming that I make something like 10 lakh rupees a year, and if my investments become 1 crore rupees worth, then I think it has become significant enough. It is equal to 10 years worth of earning. And that is the time when I should actually start building some shock absorber, so that if the market crumbles, I will not have as deep, big regret. And with that in mind, then you think in terms of, building a fixed income allocation. Fixed income allocation itself will not do it, because what will happen is that you will have this fixed income allocation. Your portfolio will not fall as much depending on how much fixed income you have. But if you don't rebalance it, you will not profit from that correction. So rebalance and have that asset allocation and keep changing it with times. Because if you retire and you don't need that money, it can well be 75% equity. But still 25% fixed income will get you ample opportunity. What are the rules of rebalancing? Will that 25% becoming 20 is that you will rebalance? Will that 75% into equity becoming 80 is that you will rebalance? Or whether it is going to be dynamic? Because if you do it too often, you will actually be creating unnecessary activity and causing a lot of tax incidents for yourself. If you wait for too long, maybe the market will fall and come back again. So you have to strike that balance, and maybe you have, and there is no thumb rule, there is no formula, there is nothing which actually will help you do it with precision. And sometimes doing it too often will also cause regret, because what happens is that assuming that somebody was working on or carrying a 75-25 portfolio of equity and fixed income in 2004 and kept on rebalancing every 6 months, because market kept on going up from 4,000 to 6,000 to 8,000 to 20,000. So that is the time when you see it in the 4th year, you might have great regret that if you would not have rebalanced, then you will have so much more money, because you are getting out of equity and the equity keeps going up, and it keeps going up relentlessly till 20,000 from 4,000 points. So, but it is not actually about maximizing return. It is about creating some discipline in your framework, because if you keep doing this, it was followed by 2008 global financial crisis. Then you will get the reverse of it. That is the time when you will be investing in equity when it will perhaps be the lowest ebb. And if somebody was doing this thing through 2004 to 2010 or 2012, when we have seen the full cycle, market going up 5 times, going down by half, and then making a comeback, I think one would have optimized his return by nearly 20%. It all amounts to doing the same old thing which we keep repeating. Diversify, invest for the long run. Once you have built something meaningful, make sure that you are allocating it to some conservative investment and rebalance it. And not forget that you have to diversify at all times.
All right, well, that's how you can safeguard your portfolio from market shocks. Now, moving on to viewers' question, which has been sent in by Bijay Gupta. He says, my mother and grandfather invested in UTI Unit Growth Scheme, 5,000 in 1995. They forgot about it, but now I found that investment paper. So can you please let me know how to redeem this amount and what is the current name of that scheme?
There are 2-3 funds which were made, which was launched by UTI, and it was not launched. It was not meant for all investors. It was meant for only Unit 64 investors. Unit 64 was India's largest fund in the 90s. It started in 1964, and it became a very large fund. And UGF 5000 was an equity fund, and it was launched and it got redeemed in 2001. And it was a good fund, and unfortunately his money is lying idle with UTI. So he should take out that paper, visit UTI's office, and get his redemption processed, because unfortunately from the period during from 2001 till 2025 his money is lying idle. Had it been an existing fund, had it been if this fund was carried over, because this was a closed-end fund, it got redeemed in 2001. And so whatever money was invested, his grandparents would have received the dividend, and the redemption, there would have been a redemption price, and that redemption price will be lying with UTI. So he should trace back that money, and he will get his money will be intact.
I hope you got your answer there. That's all we have for you in today's episode. Keep watching this space for more information. Take care. Bye for now.